If you're a small business owner, or even one whose company has recently experienced a period of growth, you've probably wondered, should I be offering health insurance? And if so, where do I start? Well, if that's you, today's video is for you. So in today's video, we'll cover health insurance options for businesses with less than 50 employees, the SHOP marketplace tax credit, alternatives to traditional group insurance, and what changes when your company grows to 50 or more employees with health insurance. So by the end of today's video, you'll have a better understanding of your obligations, your options, and how to choose the best health insurance for your business and your employees. Stay tuned. So before we talk about rules and regulations, let's talk about why some employers choose to offer health insurance in the first place. Offering health insurance can help attract better talent, improve employee retention, reduce turnover, and increase employee satisfaction and productivity. In most surveys, it is most often reported that health insurance is one of the most important benefits to employees, very often even more important than their salary. But the big question remains, are you required to offer health insurance? Well, that depends upon the size of your business. So let's cut right to it. If your business has less than 50 full-time employees, you are considered a small business and therefore not legally required to provide health insurance. But there are many employers who do so. So let's talk about some of your options. So one of the most well-known options is SHOP through the marketplace, which is small business health option programs. SHOP plans are ACA-compliant group health plans offered through the health insurance marketplace, and these are available with businesses under 50 employees. If you choose to offer one of these plans, you'll be offering predictable group coverage with comprehensive benefits through the ACA, and you'll be eligible for that SHOP tax credit. Now, this SHOP tax credit is one of the best benefits offered to you as the employer. So you may be eligible for that SHOP tax credit if you have fewer than 25 full-time equivalent employees, your average employee's wages are below a certain threshold. Now, of course, you have to pay at least 50% of the employee's premiums, and you have to purchase the coverage through the marketplace. If you qualify, that tax credit can cover up to 50% for for-profit businesses or up to 35% for nonprofit organizations. This credit is typically available for 2 consecutive years, so it's a very powerful short-term incentive. But of course, those SHOP plans are not the only option, and they may not be even the best option depending upon your specific needs. So let's talk about some of those alternatives. Now, many employers choose to purchase private insurance directly through the carrier as opposed to going through the marketplace. This can be good if you need more plan choices in some markets, broader carrier networks, or customized plan designs. The truth of the matter is, if you're looking to be more competitive, then this may be a better route for you. Because when you're comparing marketplace plans versus traditional group insurance or private insurance, marketplace plans do tend to come with a bit of a sticker shock. Even when they have lower monthly premiums, those deductibles and out-of-pocket maximums can be higher than expected, especially when compared to private insurance or group insurance. So again, if you're someone looking to attract the best talent in a competitive market, then perhaps a marketplace plan might not be ideal. Now, of course, you won't be eligible for that SHOP tax credit, and generally speaking, you're looking at higher costs, especially administrative costs, but if you need someone who needs more flexibility or a more competitive plan, this may still be the route to go. There's also ICHRA, which are individual health coverage reimbursement agreements. So as the employer, you're actually not offering insurance. Your employee will purchase their own individual plan and you reimburse them. Many employers like ICHRA's because it offers budget control, predictable costs, there's no participation requirements or administrative fees on your side, and it scales well as your business grows. So if you don't want to make a big commitment or investment into researching the best possible plan for a whole team, then this may be a good route for you, especially if you have a smaller team or remote employees who have different needs or a high turnover rate. This really puts the burden of locating the best possible plan onto your employees. However, it also allows them the flexibility to choose the best possible plan for their needs. So if there's someone who needs a plan that's specifically tailored to somebody who's looking to start a family, maybe a plan that covers IVF if that's something that's offered in your state, then they can choose a plan that will work best for them and their family with the option to be reimbursed for premiums or qualified medical expenses. Similarly, you can offer a health stipend or health allowance. This is the simplest option available to you. But they do not count as compliant health coverage, and they do not satisfy employer mandate rules. Still, they can be very useful for smaller companies, but there are limitations. Now let's talk about the big shift, reaching 50 or more full-time employees. At this point, you're known as an ALE, or Applicable Large Employer. And at this point, health insurance is no longer optional. So under the Affordable Care Act, large employers must offer minimum essential coverage to at least 95% of full-time employees. Coverage must be deemed affordable and must provide minimum value. And of course, you have to pay at least 50% of the monthly premium. If you fail to comply, you may face employer shared responsibility penalties, IRS reporting requirements, employee subsidy triggers, and this is where many growing businesses get caught off guard. Now, an area where people get frequently hung up is the issue of affordability, and that's because the definition changes slightly annually. The employee share of premiums cannot exceed a certain percentage of their income. This is adjusted annually. And of course, the plan must cover at least 60% of expected medical costs. And this is not optional. Penalties can be extremely significant. So once you've crossed the threshold, you still have several options available to you, which we are going to talk about in just a moment. But before we do, a reminder that iHealthBrokers, we're licensed health insurance brokers. We're licensed nationwide, and there's absolutely no charge for our services. So whether you are an individual who's in some type of health insurance reimbursement agreement, or you're a company who's looking to offer group health insurance, please feel free to reach out to us in the comments below or at the number on the screen, and we are more than happy to help. Of course, we do release these videos on a weekly basis, so please make sure to like this video so we can get this out there and subscribe to stay up to date. All right, let's get back to it. So if you have over 50 full-time employees, you can offer traditional large group health insurance, offer level-funded or partially self-funded plans, or ICHRA, which we've already talked about. Now, there are different cost structures, different compliance requirements, different risk levels, and that's why it's especially important that you work with a broker. Now, something that's especially appealing, especially to smaller companies that have perhaps just crossed over that 50 employee threshold, are high deductible health plans that offer HSAs. Traditionally, these will be less expensive as far as your requirement, your contribution as an employer, but many employers seek to make up for the higher deductible by contributing to a portion of their employees' HSA. The employee then has the flexibility offered by the HSA to just let it roll over from year to year and accrue interest, to utilize the HSA for qualified medical expenses, to use it to lower their taxable income, or of course to invest a certain portion of it. So this is why HSAs are very appealing to both employees for that triple tax advantage and employers, because usually your requirement, what it is that you have to pay towards an HDHP with an HSA, is going to be lower than a traditional PPO or even HMO plan. So again, health insurance really is one of the most important benefits that employees look at when determining whether or not to take a job. So it's important that you don't just choose the cheapest option. If you do that, you're not really going to attract the best and top talent. And whether you have 2 employees, 20 employees, or your company just crossed 50, there is a solution that fits your business. The key is understanding your legal obligations, your budget, and what your employees will actually value. If you'd like to learn more about some marketplace options, I highly recommend you check out this video over here, as well as our All About Marketplace playlist. Of course, if you have questions, you can reach us in the comments below or at the number on the screen. We're licensed health insurance brokers, we're licensed nationwide, and there's absolutely no charge for our services. And before you go, don't forget to like and subscribe. We'll see you next time.